I am really pleased to be with you. I am very fortunate to be working with two great friends and longtime associates. Carol Lasek and I, gosh, Carol, we've gone back at least 5 years, I think, in our relationship working together. Carol is a fascinating person for me because she's a partner in Bienfeld, Lasek and Starr, but prior to that, prior to helping her clients, particularly in the medical business in financial planning issues, she's a registered nurse. And so I think she brings a spirit of understanding to the folks that are basically in the times that we're in right now and the financial stresses and things that they're facing. So Carol, was really glad to be with you. And then my other friend is a bit of a legend in the huge town of St. Solomon's Island, Georgia. And Russell Jacobs is the founding partner of Jacobs and Coolidge and Company in St. Simon's Island. But he's also a graduate of the University of Georgia. He makes a specialty in working with clients of all different types and shapes. We've done many meetings together. And I'm sure that you're going to find lots of help and advice from these two folks that are joining me tonight. So I am going to kind of zoom in to the content of this particular meeting. I am going to close this picture panel and put that over here. So Russell and Carol, thanks again for joining me tonight.
Welcome.
Let's talk a little bit about what we're going to do for the next hour. And the first thing we want to do is try to have some fun. And I think it's interesting to turn back time and see how we got here. You know, what's the history of the Social Security system? Share some facts you might find kind of fascinating. Look at that elephant in the room question, which is Social Security going to be there for us in the future? Talk about filing strategies, some important considerations you need to think about, you know, relative to your own unique situation. Touch a little bit on taxes, and at the end, put some things together and have an opportunity to generate some questions. Now, we've got a lot of folks on the call tonight, so in some ways, when I have a group this big, it's difficult to take questions, and I apologize in advance for that. But the folks that invited you to this meeting are very capable of helping you answer those questions. And if we need to, we can re-engage and do some one-off sessions and get to the bottom of some of those questions that you might have. So make a couple notes as we go along, and we want to make sure that we get them answered one way or another. The interesting thing about what we're going to talk about tonight is it's based on current law. The Social Security system was created by an act of Congress. Obviously, it could be changed in the future, but the things that we're talking about is what we live with today. And you should know that the responsibility for making the final decision about Social Security filing strategies is really yours. And it needs to be fit in a custom way into your own unique situation. And if you want to write down a quick note, this would be a good time to start. When you apply for Social Security benefits, you open a window, and that window stays open for a year. During the course of that year, if you want to make a change one way or another, you can do that. It's fairly easy to do that. You can withdraw your application and you can start over again. But after 1 year, extremely difficult to make a change. So I'm so glad you're with us. I'm glad you're collecting this information, and I want you to, and I want you to reach out to the person that invited you if you've got further questions to go with that. So let's take that old time machine. Let's go back in time a little bit and walk into this room in the United States Capitol on August the 14th of 1935. And FDR is signing the Social Security legislation into law. And Carol, as you look at this particular picture, what is it that just strikes you? What do you notice about this?
Oh, it's pretty apparent that there is one woman in a room of a dozen men.
Yeah, pretty apparent. And lots of people, when they look at this, want to think that's Eleanor, but we know that's not the story. That person is actually a legend. That's Francis Perkins. FDR, when he was the governor of the state of New York, Francis Perkins worked for FDR as his Secretary of Labor. And he was so impressed with her capability and her skills that he brought Francis Perkins to Washington, D.C. She was the first woman appointed to a United States cabinet position. She held the Secretary of Labor position longer than anyone. But the reason she's in that picture is that Frances Perkins and the committee that worked with her wrote the law. They created the Social Security system. But turn to other things that Frances Perkins did for us and think about 2020, because Frances Perkins established the concept of unemployment compensation. Today, my daughter is furloughed from her job. My son is furloughed from his. Unemployment is very important today in our society, and we can trace the roots of that program back to Frances Perkins. But not only did she do that, she worked on workman's comp, established the idea of a minimum wage, started the legislation to abolish child labor. For those of you who have been to many national parks, the Civilian Conservation Corps created lasting legacies of this particular sort of visionary person, and really without much recognition. Finally, though, somebody said it would be a great idea to take that Department of Labor building down in Washington, D.C., and name it the Frances Perkins Building. By the way, that's the square one that's on the left side of this particular picture. She left us an incredible legacy. There are two parts of the United States DNA fabric in 2020 that can easily trace back to the FDR era. Certainly one is Social Security, and the second is on the front door of every bank that you walk into in the United States, represented by 4 letters, and that's the FDIC. Think about the country without the Social Security safety net that we have today, or the safety of knowing you can put money in a bank and it's going to be guaranteed by the full faith and credit of the United States government. So we're living on the legacy on the shoulders of a giant, and many of you maybe have never heard of her, but we want to thank her for her vision into the future. So they signed that legislation in 1935. But it didn't start immediately. It had to figure out how to get people enrolled. And then they started distributing payments to the beneficiaries. And one of the very first beneficiaries in the system was our friend Ernest Ackerman, who was a railroad car conductor in Cleveland, Ohio. Now, Carol, I know you know the answer to this, but let's pretend that you don't here just for a second. And this is going to be the multiple choice question. This lump sum payment, which is the way the whole system started back in 1937, do you think our friend Ernest Ackerman got $95, $19, $8, or 17 cents? If you didn't know the answer, what would you have guessed?
Well, 17 cents.
You did. It was the right answer all along. Now, why could it be 17 cents? Well, because he basically retired after he started paying into this Social Security system. Paid in 5 cents, he didn't make a lot of money, he got a lump sum benefit for 17 cents. To put that in perspective, you could go down to the local post office and buy a 3-cent stamp that would pay for a first-class letter. So he could mail a few letters, have a little bit left over, and ride off into the distance of his retirement. Clearly, paying lump sum benefits was not going to work for the Social Security system. And by 1940, they moved it or morphed it into an annuity-based system. An annuity, something is paid to you every month for as long as you live. And the first annuitant was Aunt Ida Mae Fuller in Ludlow, Vermont. Aunt Ida Mae paid in $24.75. And that generated for her a benefit of $22.54. But Aunt Ida knew what the secret sauce of any annuity type program, and that secret sauce is longevity. Aunt Ida lived till she was 100 years old. She lived for 35 more years, collected $22,000 in benefits. And Aunt Ida's lesson, we're going to weave through this entire presentation for the next hour or so, because longevity is a huge driver in making the right decision about a filing strategy for Social Security benefits. By the way, I don't know, Russell, in St. Simon's Island, could you buy one of these for $802 today? What do you think?
No, not even close.
You could even
Not if it looked like that, especially.
That's exactly right. So, by the way, 1940, that's we buy at the local Chevy dealership for $802. Things have certainly changed since then. In fact, the entire Social Security system has changed since then. Let's take a look at numbers that go through 2019. These are the latest and the greatest numbers we get from the Social Security Administration. And you have to think about Social Security not as just a retirement program. It's actually 3 programs under the umbrella of Social Security. And one of the very significant benefits is a form of life insurance or survivorship. There's 6 million people collecting survivorship benefits in the United States today. I want to turn my wife's clock back. When she was 3.5 years old, her father died. She was recipient of Social Security from 3.5 till she graduated from high school. She had a sister, also received that same benefit amount. Those Social Security checks, those survivor benefits, were very significant. Her mother was a working mother. This allowed them to maintain their lifestyle. So for younger people on this call, remember that survivorship benefit is super important for the near term. Hopefully you would never need it, but at the end of the day, that's part of the program of this 3-legged stool. The second part of Social Security is a disability income program. There's 10 million people in the United States taking disability benefits from this system. But by far, the largest number of recipients in this program are the retirees, 48 million of them. And if you add the retirees, the disabled workers, and the survivors, that gives you 64 million today as we're on this call taking benefit checks out of the system. And if you added every one of those checks, you would come up to $88.25 billion a month being paid out to folks in the system. By the way, this represents the biggest single item in the federal budget. 24% of the federal budget is dedicated to paying Social Security benefits. If you want to put that in comparison with something, 19% is what pays for defense. And if you do the math, and this is kind of the staggering number, I think you'll find interesting. You take that 88.25 and multiply that thing times 12, and you get a number that's north of $1 trillion. Well, how does all this money get into the system in the first place? And we pay it. This isn't some welfare program. This is a program that we're funding with our own tax dollars. We pay 6.2% of our income into the Social Security system. Another bit of good news, 1.45% of our income is paid for Part A Medicare. It's basically pre-funding the Part A premium of the Medicare program. So 7.65%. And the employer matches that, 6.2 up to the wage base, 1.45. Well, what's this wage base thing? There's a big difference between the Medicare tax and the Social Security tax. The Social Security tax, you pay that 6.2% until you get to $137,700. That's the number in 2020. That's indexed over time, much higher today than it was, and we expect that to probably go higher in the future. But Medicare does not have a wage base. You pay that Medicare tax on all of your income. And for those of you who are self-employed, and many on this call might be in that category, you're effectively paying both sides of the tax. So that's where the money comes from. And as we mentioned, if you take those benefit checks, multiply them times 12, you have this huge income stream coming in and this going out at the very same time. $1.062 trillion of money is coming into the Social Security system through the end of 2019 in 1 year. And at the very same time, out went $1.059 trillion. So $1.062 trillion came in, $1.059 trillion went out. And you can see by looking at these numbers that we actually took in a little bit more than we paid out. And that's by design. Back in 1983, the Social Security system was under incredible stress. Ronald Reagan was the President of the United States. Tip O'Neill was the Speaker of the House. They knew that something had to be done to fix this very important program and said, let's put a committee together typical Washington, D.C. response. And they went down 16th Street and found an unheard of business analyst. First name was Allen, last name was Greenspan, is not yet the chairman of the Fed. They built a bipartisan commission, 1980, 1981. It was finished in 1983. And one of the things that those folks figured out is that they needed to start collecting more money than they needed back in 1981, 82, and 83, because all those people who went to Woodstock, all those baby boomers, they at some point in time in the future would be looking to cash in and take those retirement benefits from the Social Security system. So there's been a forced savings program in place ever since 1983. And they've saved a lot of money in the Social Security system. They're up to almost $3 trillion, 2.897 to be exact, at the end of last year. And that represents the Social Security Trust Fund. Money goes into the trust fund from three places: the FICA tax payments, the interest on the money that's in the trust fund, which is right now paying at 2.8%, and income tax that people pay if they go over certain income levels. So think about this gigantic system. And there's money going in, there's money going out, 178 million people contributing. Probably the one thing everybody on this call has in common is that you're all paying FICA taxes into the Social Security system. And it's good to know exactly how all this is going to work. And the good news is we've got this almost $3 trillion sitting in the trust fund in the form of government securities. But in 2020, almost like Alan Greenspan anticipated back in the day, we're going to begin looking at that savings account to begin paying the promised benefits to the folks that have been paying into the program. And in 2020 is the first year we've started to tap into those government reserves to pay those promised benefits. Now, Carol, you were incredibly successful at what you do, but I'm going to offer you a new career in life. How does this sound?
Not so sure. I've had a couple careers in my lifetime.
I know. So let's think about this one. Let's suppose you run for Congress in the state of Florida, and you're very well received by the voters in the state of Florida, and you do extremely well, as you've done in everything that you've done in your life. And in 2035, you find yourself in the third most powerful position in the United States, the Speaker of the House of Representatives. Now, Carol.
My house.
Yeah.
I'm not so sure I want to be Speaker of that house, but go ahead, sorry.
So there you are. You're the Speaker of the House of Representatives. You're sitting there in Washington, D.C., and you have to stand up in front of the American people. And at that time, 70 million people are receiving benefits from the system, and explain to them that you're cutting their benefits by 21%. Carol, is that a job you want?
I do not want that job. I would never want that job. Be in front of all those people telling them that I'm going to take their benefits away. No. Won't happen.
It's a political impossibility, I would say.
Absolutely.
Almost impossible. Where you could have someone that would look at people who've been paying into the system all this time and have said, okay, we're gonna have to cut your benefits by 21%. But there's time. Because, Carol, you're in a leadership position in the House of Representatives, the smart thing to do would be appoint a committee. And that particular committee, House Ways and Means Committee, for example, could sit down and say, well, what could we do to fix this shortfall? And you can really look at the revenue side, or you can look at the benefit side. Remember that Social Security wage base we talked about, that 137,700? Right. What's so magic about that? Carol, would it make sense to maybe change that number?
Not while I'm in office, that's for sure. But possibly, yeah, to make it higher, absolutely.
Yeah, you could. We've had focus group meetings here in Boston, very much like everybody on the phone tonight, and asked them, well, what would happen if we changed the Social Security wage base? And that's the number one thing people hold their hand up and say, yeah, we think that's a good idea. And before COVID and the crisis of the pandemic hit, Richard Neal, who's the president of, or who is the chairman of the House Ways Committee, actually has legislation going through committee on how we could fully fund Social Security into 2100, the project for looking ahead 75 years and say, well, what would we do? And one of the things that's on that list is raising the earnings cap. We think that that's probably in the cards. But Carol, who pays, if I raise the earnings cap, Who pays that?
We do.
Yeah, you do. And if you have income over 137,700, that's a tax increase for you.
Right.
And also the companies that employ you. So
Right.
that's a bit of a hard sell.
Yeah.
Popular one, but a bit of a hard sell. Let's go the other way though. Let's now talk to people across the board, everybody that's in the system, 178 million people. What if we took that 6.2% and raised that a little bit? Who pays that tax, Carol?
We all do.
Everybody. Exactly right. Everybody pays that.
I'm
And
not
that
voting for
is
that.
a
I'm not voting
regressive
for that.
tax. Go
I'm
ahead.
not voting for that person.
Yeah.
Or maybe I would. I don't know.
Yeah. Well, that's a regressive tax. Everybody would pay. That's also a hard sell.
Yeah.
Over on the benefit side, we've got another one, and I think this one is coming as absolute guarantee. When my father retired and took benefits from the Social Security system, his full retirement age was 65. Mine happens to be 66. There's a definition of old age in the Social Security system. It's born after January the 1st of 1954. You're young. Born prior to that, you're old. I'm in the old category. If you're born after that, like my son and my daughter, you're going to probably looking at an increased retirement age benefit. And that's not all horrible. My son lives in San Francisco. My daughter lives in Northampton, Massachusetts. They have time to adjust their thinking, just like I did as my father changed his full retirement age. I changed mine. I think younger people will change yours. So, Carol, if you're the Speaker of the House of Representatives, what do you think the solution is here?
Well, it really is up to the people on what they want to contribute to the system.
Yeah.
You know, there's many solutions. It's just whether or not we want to vote for those solutions. And
right,
it's a hard sell.
But don't you think it's going to be a little bit of everything? We're going to tweak the earnings cap a little bit. Let's tweak the contribution rate. Let's take a look at the retirement age. And by doing that, there's not that much pain. We can spread this out across many, many different layers, and we can restore the funding for Social Security into the future. That does not keep me up at night. I get lots of calls. I actually had one this morning that said, should I file at 62 just to save my place in the system? No, it's going to be there. And if you're younger, like Noah, for example, you could probably be looking at an increased retirement age. But for many of us, we're going to be seeing a very much level of stability. Remember, the increasing retirement age that we're living with right now was started in 1983, and in 2020, we're beginning to see those retirement ages increase. It takes a long time to make change to a system of this magnitude. All right. How do you get into the basics here? Well, you earn a credit. When you make money in the Social Security system, you earn a credit. How much? $1,410 is one credit. How many can you get in a year? You can get 4. That means when you make $56.40, you get all the credits at one time, or you can get them over the course of the year. But part of the brilliance, I think, that Frances Perkins brought to the table with her committee is you earn these credits, and you have to have 40 credits to get in the club. To qualify for retirement, you have to work and pay those credits for 10 years. But there's absolutely no relationship between the number of credits that you have and how much money you take out of the system. The more you pay into the system, the more you would take out of the system. So keep that in mind. Those credits are really important. 2 definitional terms, again, to write down. Hopefully you'll leave this seminar tonight with these 2 points of information. Your full retirement age. I'm a bit of a walking dinosaur, born between 43 and 54. My full retirement age is 66. If you take a look at someone who was born in 1960 or later, their full retirement age is 67. This is that grade-in structure that the Greenspan Commission developed in '83. If you were born in 1958, 57, 56, 55, 59, any of those years, your Social Security birthday and your real birthday are different. Someone born in 58, as an example, 66 and 8 months is your actual Social Security day. That's when you reach your full retirement age. And why is that full retirement age so important? Because at that date, you receive your primary insurance amount, your PIA, kind of a government term. You should have called it the size of the check. That's when you get 100% of your primary insurance amount at your full retirement age. Now, how much you actually get from the system totally depends on four things. When you start, how much money you paid in, your marital status, and what did Ida Mae Fuller teach us back in Ludlow, Vermont? Longevity. It's the combination of these four things that determines the size of your benefits from the Social Security system. So let's look at a statistic that's kind of interesting. We know that 69%, based on the year of 2019, would take their benefits on or before their full retirement age. So let's go to a quick little case study and talk about that for just a second. So there's Dave at 66. Full retirement age, 66 and 6 months. Let's suppose my FRA is $1,000 a month. If I were to take benefits at 62, I wouldn't receive $1,000 at all. It would be actuarially reduced to $725. The flip side of that is that if I waited past full retirement age, to age 70 in this example, I would earn something called delayed retirement credits. That's 8% per year simple interest between full retirement age and age 70, and that would mean that the benefit payment for me at age 70 would be $1,280, and that's a 76% difference between 62 and 70. Now, the Social Security system is based on actuarial science, on the law of large numbers. And they know, based on that average number of everybody in the system, that males should live to about 83 and females to 85. So if you started your benefits at 62 and you lived to life expectancy, or if you started them at 70 and lived to life expectancy, you get exactly the same amount. Aha. But people aren't statistics in the law of large numbers. Carol, as you look at this chart, the folks down here at this end, those people,
Yeah.
What's going on in their life that might want them to consider taking the benefits early?
Well, they may have a health issue. They may know that their longevity is not in the cards. They don't have those genes.
Sure.
And maybe they simply need the money, or maybe their family member needs the money.
Correct. Those are two of the most dominant reasons why people would file for benefits early. There was a classic study done by the Federal Reserve that asked a lot of people and said, why did you take the benefits early? And they said, well, just because we could. Then they discovered that maybe wasn't such a good idea. But Carol is exactly right. There are two really important reasons to take benefits early. One, you absolutely need the money. And number two, your health projection is not good. Ida Mae Fuller taught us longevity is the magic sauce here. So Carol, if folks who don't have longevity, who need the money, may want to look at early filing strategies, what about these folks over here? What's going on with them?
Well, maybe they don't need the money as much. Maybe their health, they know for a fact that they're going to live a long time, and they want to make sure that they have that dependable check every single month for a long time. And they also know that, between the husband and wife, one of them is going to die first, and they want to make sure that that ultimate check is going to be as large as they can for their remaining spouse.
That's absolutely correct. It's interesting in my family. My mother died at 95, my father at 92. I am kind of on the right side of this spectrum. My wife's mother died at 75, and all of her aunts and uncles, my mother-in-law's aunts, brothers and sisters, all died in their early 70s. So even within a family, you could have different kinds of life expectancies, which makes filing strategies a little bit tricky. So we have to keep thinking about longevity as that driver. Let's take, though, another point, and I want to refer you to this socialsecurity.gov website, ssa.gov. Fabulous resource. You can go on that site, you can go right to this particular page, and in about 3 minutes, find out what your projected benefit would be. But it's a very rough estimate. Several years ago, the Social Security system started introducing online access to your Social Security information. And they created something famously called the My Account. This is your own private website with the Social Security Administration. It doesn't cost anything to sign up. You have instant access to your records, day and night. And if you sign up for a My Account, you can get the fabled green line form. Carol, Russell, you and I all remember we were mailed these green line forms. Remember those days? Back in the day, we used to get these in the mail, but you don't get those anymore, particularly if you're under 60 years of age. Now you have to get them online. And if
You
you
do
get
have
them,
to know some pretty arcane information about yourself to get onto this system, though.
that's standard. Did you have a bank account with some bank, or did you ever have this kind of car? You've had that experience, but most of the people that have done that have been able to get through that process and get access to this green line form. The green line form tells you some wonderful things. The first thing it tells you is how much money you're going to get at, guess what, your full retirement age. And remember, these are not inflated dollars. These are dollars that are expressed in today's dollars if you continue working at your current earnings rate until 67, 70, or 62. So that'll get you into the ballpark. On page 3, however, of that green line form, you're going to find your earnings record. And in this particular earnings record is going to basically your bank account with the Social Security Administration. Every contribution that you make is going to be recorded here. Now, Russell, let me ask you a crazy question. Is it possible there could be a mistake on this form?
Absolutely. We've had it with at least 2 of our own clients. Wrong birth dates, just different things like that. So they definitely make mistakes.
Yeah, and it could be 1099 income, people who have changed jobs. Russell, let me ask you a crazy question. If the mistake is made, is it in the government's favor or your favor?
Yeah. It's usually,
is that a loaded question or what?
Yeah. They're from the government. They're there to help.
Yeah, that's exactly right. And what would be a good time to be checking to see if this is accurate? What do you think?
Well, at least once a year, because you only have a year to correct it.
Yeah, you've got a limited window of time to collect it. And I think a good time to do that would be when you do your taxes. To file your taxes and get online, open up your My Account, and figure out that you're being credited correctly for your earnings history on the Social Security system. Now here's an interesting role play. And Russell, you and I are going to play this together. So let's suppose one day, Russell, you're coming back. I know you live with your iPhone because I've been with you many times. And there's a voicemail message on your iPhone. And this is a role play, but that voicemail message sounds something like this. Russell, this is Dave Freitag calling from the Washington, D.C. area and the Social Security Administration office. I regret to inform you that there's been suspicious activity on your Social Security number in the state of Texas. Therefore, we have immediately suspended your Social Security number. You must immediately call this 800 number to resolve this situation. Do it very quickly. Russell, have you had a call like that?
I have not, because I'm so young. But yes, we have clients who've had that call.
Yeah. And what should you do if you get that call?
Hang up.
Don't answer, never call back, hang up. This is a national scam. It's nationwide, it's plaguing the system. Should you visit ssa.gov, you will see they have definite screens dedicated to the fact that this scam is taking place. People are fishing for information. They're trying to illegally get access to your Social Security account. By having your own website, your My Account with the Social Security system, what you're doing is a very defensive move because you're putting your unique username and password in front of your Social Security number. So a to-do from today's seminar, if you haven't set up your own My Account, do it for security reasons, number 1. Number 2, to make sure there's no errors on your taxable earnings. And just to keep track of this incredible program and what's going on. I happen to be collecting Social Security, and I use My Account. If you want to direct where the money is going for bank deposits, you need to order a new Social Security card, get confirmation that you're in the system. All of that happens on that website. This is a tremendous resource. And should you do it for your kids? Absolutely. Put that username and password in front of those Social Security numbers to protect them from thieves. All right. So that's the one thing. Let's get to longevity. This is one of the 4. Longevity is the second one. We licensed this cartoon from the New Yorker magazine. I guess I'm the only guy that gets it, but I worked with someone that said everything is great until one day that it isn't. You never know what longevity is going to look like, but if you need some help, you can go on the socialsecurity.gov website. It's a very, very simple, basic calculator. You can put in your sex, you can put in your birth date. It'll give you an estimate of longevity just based on those two factors. But that's not a very accurate methodology to follow for longevity projection. I think it's much easier to look at your own parents, aunts and uncles, lifestyle, do you eat granola, do you exercise, do all the things you're supposed to do, and you have a better idea of what longevity is going to be. You absolutely have to get a handle on that, as you'll see when we get to filing strategies in just a second. And we're going to talk about filing strategies. Remember, the definition of young in the Social Security system is born after January the 1st of 1954. So here we have Sam and Lee, a young couple, 56 years of age. They went on socialsecurity.gov, found out what their projected benefits are going to be. $2,500 for Sam, let's say $2,000 for Lee. They looked at their family, their lifestyle. Sam felt 85 was a good longevity assumption for him. 90 was a good longevity assumption for Lee. We built in an inflation rate of 2.5%. And if we take those variables and put them into a planning tool, this is actually a screenshot of the planning tool that we use to help people get their arms around their choices. We see that Sam has 9 ages to start taking benefits from Social Security. He could start at 62, go all the way out to 70. And we see that Lee could start at 62 and take those choices all the way out to her age 70. And simple math would tell you that Sam and Lee have 81 different age combinations. This can be very, very confusing. So I call this a vertical view of the Social Security shopping mall. Every one of these is a store, basically in that Social Security shopping mall. And you can look at any one of these stores to figure out, is that the best place to get your Social Security benefits? Is it 70 and 70? Is it 62 and 62? And there's an enormous spread between these stores. So for example, if you went to the 62 and 62 store, the payout over life expectancy is $1.6 million. On the other hand, if you lived to life expectancy and started at the 70 and 70 store, the payout is over $2 million, and that delta approaches $500,000. And when we've worked with clients and helped them look into their choices, when they look at this delta, they want to go shopping in more than 2 stores. They don't want to start early, they may not want to start late, but what is the best matrix? What's the best strategy that could make that work? For example, Sam and Lee might look at their own situation and say, wait a minute, my full retirement age is 67. Shouldn't I just start my benefits at 67? Doesn't that make a lot of sense? And it might, but again, you could be walking away from over $185,000 if in fact you lived to life expectancy. So everything is a trade-off. When do you start? When do you step? As Carol said in the beginning, longevity factors into this, financial need factors into this. But you need to make the decision on purpose. This is a common theme that I want to leave you with. Don't make the decision by accident, make it on purpose. Have some sort of a roadmap to follow. And of course, we have a planning tool that can help you with that roadmap. Let's jump and just summarize that younger people, many of you who were born after January the 1st of 1954, if you want to get the most out of Social Security, it's not going to be taking it early. It's going to probably be deferring to later, and that means you need a financial bridge or need to be thinking about working longer to take money out of the system. All right, here I am. I'm the older married couple. Again, born before January the 1st of 1954. And for many of you on this call, could find yourself falling into this opportunity, and it really is an opportunity. There was a special grandfather clause in the legislation that was passed in 2015 that gives you an opportunity to do something called restricted filing. And although we've known about this since 2015, almost weekly we find clients that have never heard of it, and it's called restricted filing. Let's walk through a sample case of a restricted filing strategy. Here we have our friend Mary. She, at 66, starts taking her retirement benefits from the Social Security system. The only increase that Mary would receive over her lifetime would be because of cost of living increases. Aha! But what Mary also does is set up a magic window. And that magic window is for her husband, Bob, because Bob could then start collecting spousal benefits from Mary's record, but at the very same time, earn 8% per year in delayed retirement credits, which means that age 70, Bob could take a 32% increase on his record, and ultimately, if Mary outlives him, that would add a bonus to her survivor benefit as well. Let's take a quick look at these numbers because I think they're interesting. There's Mary's benefit, $1,028. She starts it at 66. Bob gets half of that, $564, $1,600, $1,692 a month. The magic happens, the multiplier happens right here at age 70. Bob's benefit goes to $3,500. Remember, it started at 25, went to 35. $1,000 more a month, almost $5,000 a month in benefits. And Carol, let me ask you a question here. If I walked into your office and I have now moved you from the House of Representatives and you're now sitting there and I say, Carol, I'm here with Jenna, my wife, and we want to get a guaranteed income stream for the rest of our life. We want you to increase that guaranteed income stream at 2% per year. I've got my checkbook right here in my back pocket. I'd like to write you a check so you could guarantee me I would get this $5,000 a month for as long as we live. How big a check would that have to be for me to get that guarantee from you?
It would have to be a big one, like
be
north of $1 million at least.
Absolutely, well north of $1.3 million. And so many people take Social Security for granted until they turn it into a capital asset comparison. It takes an enormous amount of money to generate this cash flow. And if you're making notes, you might want to remember that you've paid for this thing for 35 years of your working life. So think about this $1.3, $1.4 million asset, particularly in lower interest rates environment we have today, that's going to be there for you in the future. You would not make a casual decision about what to do with $1.4 million if it was in a suitcase and you dropped it on your front porch. You wouldn't do what Uncle Lou told you at the family picnic. You'd try to get some good advice to figure this out. And this is a huge resource. Probably one of the biggest assets you'd bring into retirement for many people would be the capital value of their Social Security benefit. So everything is great. It goes on until one day Bob is going to leave. He's going to die and Mary's going to be by herself. And they were getting almost $7,000 a month. But when Bob died, Mary's income fell to $5,000. This is the phenomenon called one check, not two. Remember, this is an annuity system. You got to be here to collect. And Carol, if you look at this and you think about this white space over here, what's the probability that this is going to happen?
Remember, I'm a nurse, so I know the answer to this. One of us is going to die. Someone's going to die first.
Yeah, this is 100% certain. And I use this analogy, and maybe it works and maybe it doesn't, but I'll use it again. If you had a ticket on the Titanic and you were down at the Southampton dock, but you knew what the future was coming, would you get on the boat? Maybe not. Everybody knows and should know that in the future, these Social Security cash flows are going to stop. And you can do nothing about it at 85. It's too late. You have to do defensive planning over here in your years before you start taking Social Security to make sure that this 100% certain event happens in the future. You can prepare for that. And being prepared for this is really good planning. All right. Well, what if they just said, wait a minute, we're not going to do this restricted filing. I'm an older person. I'm just going to start taking the benefits early. I mean, the dynamics here are incredible. Over life expectancy, it could mean over $200,000 in more benefits because you're old by Social Security definition. You were born on or before January the 1st of 1954. All right. Take a look, though, at the survivor benefit, and this is kind of interesting. As Carol pointed out, this is 100% certain. Remember, one of the things she talked about was by delaying, you're also pushing a benefit to the survivor. And in Mary's case, if they did not do restricted filing, she could be looking at $3,600 a month, not over $5,000 a month. So there's lots of dynamics going on for people making Social Security changes, and you really do need software and tools to help you make the right decision. Now, The gigantic Supreme Court case was passed, and what that did is make same-sex couples the same as everyone else. And because of that Supreme Court decision, spousal benefits and survivor benefits were added in the form of Social Security benefits because you were legally married or you had survivorship. These are new benefits. This is good news and bad news. The good news is that same-sex couples are now the same as everybody else. The bad news, like pretty much everybody else, they have no idea how they work. So what did the government do? They created a new web page just for people who can go through the new additions to their financial planning using this resource from socialsecurity.gov specifically for same-sex couples. Now let's go into divorces. Not all marriages last forever. So in this particular case, if you tick off a couple of requirements, if you were married for 10 years or still divorced, 62 or older, and if you were born before January the 1st of 1954, you still have access to that restricted filing strategy. Let's look at Nancy here just as an example. Married to Alan, divorced, Nancy's benefit $1,400 a month, Alan's benefit $2,600 a month. What could Nancy do? Nancy, at 66, could take benefits from Alan's work record, 50% of them, but at the very same time, earn those delayed retirement credits so that she could get, in fact, a 32% bonus when she turned her own benefit on. The impact of this is unbelievable. Let's take a look at Nancy. If she just filed at 65, over her life expectancy could receive $535,000. If she did restricted filing, she could receive over $700,000. That delta is $171,000. Russell, you and I actually had an experience that met this particular criteria. I wonder if you could share that story. I think it's really interesting.
Yes, we had Dave come down and speak to one of our client companies, have several hundred employees, and after one of the sessions, which was similar to this content being shared, we had a person come up and who thought she might be impacted by this. And Dave looked into it with us for her, and as it turned out, she was divorced, met the criteria. She had a child that was going to take lifetime care, but she got a $5,000 lump sum back payment for when she would have been eligible for it to start initially, in addition to almost $1,000 a month she was going to receive until she was 70 years old. And then, as I recall, she was in her late, I forget how old she was.
She was 67. She was 67.
Yes, she was going to get that for 4 years.
Right. She's going to. It's an amazing story. The phenomenal thing about these stories is, and I had an interview with a client on Long Island, and in typical New York way, said, "Well, what's the catch?" The catch is you have to know how to do it. Restricted filing is very, very powerful, and not a week goes by where I visit with someone who's never heard of restricted filing. Carol, you've been through some restricted filing strategies, I think, in your practice as well, correct?
Yes. Yep. In fact, my husband and I are prime example of that restricted filing on, giving each other a restricted filing benefit.
Mm-hmm.
So.
It's amazingly
you
powerful.
Put Howie on restriction? I'm sorry.
He is restricted, absolutely.
He is restricted. I get it.
Yeah.
You can tell we're all good friends here. I want to talk about this one a little bit as far as survivor benefits. Survivor benefits are not, or people who have lost a husband or a wife, are not impacted by that crazy date, January the 1st, 1954. There is no date. So when someone dies, you can, in fact, do a restricted filing strategy. Kathy, in this particular case, loses her husband, Bill. She collects those survivor benefits from him, from his record, which allows her to earn those 8% per year delayed retirement credits and get that up to 32% increase on her own record. I've been working in this space right now almost 8 years, and I would get questions about survivorship infrequently. But since March, unfortunately, I've had many, many calls. We've lost over 135,000 people that we know and love that have fallen into Social Security filing strategies for survivorship. And there's different strategies that can affect the choice for widows or widowers. So we have to know how those work. They can make a huge difference. In this particular case, if we look at Kathy, she said, well, maybe I should just wait to 70 and start taking benefits then. Well, the payout over her lifetime, if she only lived to 85, $468,000. On the other hand, if she filed at 66, 560, that's close to $100,000 difference. And if her life expectancy was longer than that, those numbers would be much, much larger. Restricted filing does not require that famous date. You can start survivor benefits as early as age 60, and you've got choices from 60 all the way up to age 70. So keep that one in mind. Single claimants, Carol, probably in your practice, you don't get a lot of people who are confused about claiming if they're single. I mean, if you took a look at this screen, somebody 62, if they started benefits, maybe 1,800 at age 66 and 8 months, it'd be 2,600, maybe 3,900 at 70, with some inflation factors built in. It's really a projection of what do they need. You know, what do they need to make their life work? So single people, not so much. Is that what you found, Carol?
Yes, and of course we know that you know, today that the great old pension plans, the pension plans that existed many years ago don't exist today. So it really is a matter of what they really need. What do they need to live on? Proper budgeting and how does it fit into their overall financial plan?
Yeah, absolutely correct. So single people, not so much. Well, there's some other things to think about. Let's talk about the dreaded earnings test here just for a second. The Social Security system puts a brick wall in front of or between you and benefit payments if you're still working prior to that famous full retirement age, that FRA date. If you're working before your full retirement age and you exceed, not a lot of money, $18,240, see it here, for every $2 over that amount, they're going to hold $1 back. And if they hold that dollar back, it's not lost forever, but it would be paid out to you, not in a lump sum, but over your life expectancy starting at full retirement age. But therein lies the problem. They withhold the benefits over a very short period of time. And if you don't live a long time, you'll never recover them. So filing, and there's one rule, there's 2,800 different rules in the Social Security system, maybe more. But there's one rule that you can universally apply to pretty much everybody. If you're still working and it's before your full retirement age, taking benefits early is not such a good idea. On the year of your full retirement age, that benefit amount goes up, or the earnings test hurdle goes up to $48,600, a little bit more liberal. And it's a 3-for-1 relationship. For every $3 over the $48,600, they hold $1 back. But filing early, probably not such a good idea. Oh wait, what about income tax? Let's talk about that just a minute. Remember, 1983 is when income tax started in the Social Security system. If you look at someone married filing jointly, you come up with this rather bizarre definition of income. It's called combined income. Adjusted gross plus non-taxable interest plus 50% of your Social Security benefit. If that number is over 44,000, then you could report up to 85% of your Social Security as taxable income. Now, you don't get taxed 85%. You just report that at whatever bracket that you happen to be in. Now, Russell, here's a crazy question. If you took money from an IRA, how much would you have to report?
All of it, unless
All
it's
of
a
it.
Roth.
100%, right? On the other hand, if you take money from a Social Security check, you only report at the most 85%. There's always a 15% or more advantage between a Social Security check in retirement than the distribution from a traditional IRA or qualified plan. So that makes these dollars very, very powerful. You can buy more with the Social Security dollars because you're not giving it all or reporting it all as income. All right, take a look at the state of Florida. You can see that in the southeastern part of the United States, most states do not, of course, Florida doesn't have state income tax. You don't have to pay income tax on your Social Security income. That's not in the case of Massachusetts, where I am. We pay state income tax, but we don't pay it on Social Security. So you can see you're in a good shape from an income planning for taxation purposes in the state of Florida. I'll say let's kind of put some things together. We're kind of coming up on our hour here. It's not always about the money. Do you have health concerns? When do you want to stop working? Do you have access to other assets? Do you need income right away? Carol, you can relate to this one. I went into a shop in Hawaii one time, And in Hawaii, it was a shop for men and women, and one size fit everybody. I could get a Hawaiian shirt, my wife could get a Hawaiian dress. There wasn't any difference. Everything was the same. And that is 180 degrees different than what Social Security should be. This is a custom-made suit, a hand-tailored dress. It needs to be done exactly for your unique situation. You cannot do what Uncle Lou did at the family picnic. He said, I took it when I was 65. That's what you should do. Dave, that's the right answer. No, you really need to get that custom-made suit, that handmade dress, exactly fit just for you. And you might want to know the answer to this question. How does Social Security fit into the bigger picture of income planning and retirement? And Carol and Russell are experts in this space. And we use something called a 4-box strategy, which is really quite simple. You can do it on a yellow pad. You can take on the left side in this quadrant of that yellow pad and write down your necessary expenses. What do you have to have? Food, housing, healthcare, and other things. And below that, you can write down, what do you need? What do you want to do? And then the key is over here, to make this work right, you want to balance the predictable income against the necessary expenses. And in most cases, Social Security will be one of the biggest predictable income sources you bring to the retirement planning table. There's a lot of other dynamics that go along for sure, but this is one of the most important. And you have to make that decision probably first to figure out what you have to do to supplement those other sources of income. So here's a list. So Carol, why is it important to get that My Account? You know, tell me again.
Well, because we know that your earnings, your benefits are based on your earnings, and if your earnings are not correct, you have just a certain amount of time to correct that.
That's exactly right.
Yeah.
You know, those thieves are out there. Got to get that.
Right.
Remember, it's not mailed to you.
This is
Go ahead.
your account, right?
Yeah, you have My Account. Get that. As Russell said, you might have to answer some crazy questions to get it. But a takeaway from this meeting is everybody should have a Social Security about My Account. You want to verify that Social Security statement. As Russell said, if there's a mistake, you want to get it fixed. Your full retirement age. You looked at the chart, you now know what it is. Mine happens to be 66. I look back at that in fond memory. But you want to look at your financial concerns. What are you planning to stop working? What is the income need that you need in retirement? And of course, there's taxation associated with that. So now you're in a situation where you might need to talk to a tax advisor as well. Well, how in the world can you get help? Going this Rubik's Cube of solving the Social Security filing dilemma. Well, you can go to socialsecurity.gov. That's a good place to start. In the past, it was possible for you to walk down to the local Social Security office, take a ticket, go in, talk to somebody, and ask them some questions. Since the middle of March with COVID, you cannot do that any longer. Particularly the age of the people that the government's dealing with here puts them in that very exposed classification of people that could be at risk. So the Social Security offices are closed. That doesn't mean they're not there. There's people in there working. You can call the local number and get access to them, or you can try calling the 800 number, a fairly miserable experience in some cases because it might be a long wait to get through that 800 number. They have done some good defensive things lately where you can give them their number, and then when your number comes up, they'll call you back. So that's a good place to get help. But I think the person that invited you to this meeting would be a great place to go to get help and answers to your questions. So we pretty much used our hour. Carol, I want to thank you for making contributions. Would you like to add a comment or two?
I want to thank you, Dave, for your expert advice. And I have to just mention that I have heard you in the past, and every time I do sit through one of these webinars or seminars, I always pick up some additional good advice. So thank you very much.
So that's great. And what about Russell? Russell, have you got any some closing comments?
Yeah, I would just say, concur with Carol that you're always a great presenter. You always bring energy and interest to the presentation, but that we've done this several times with you, and invariably, I mean, there's over at least a dozen people that I can just think of off the top of my head that found more money that they weren't or wouldn't have ever gotten, and into the thousands, multiple thousands of dollars that is a game changer for them. And the government's not going to publicize this,
Right.
These strategies and you have to find out on your own. It's up to you to check it out, and so take the personal responsibility and the time to do so.
I mean, Russell, I can remember like it was yesterday when we talked to your client in Brunswick, Georgia. This was a life-changing experience for her. It provided money. It gave her income she never knew about. It gave her a bonus in retirement. Being smart about making good decisions about Social Security is a good thing to do. And we want to provide that help. This is a value add for being clients and for being a good, wonderful people. Thank you so much for your time tonight. I want to quote Lester Holt, if I could. I want you to take good care of yourself and all the people that you love. Noah, I'm going to put this back to you. If you have any comments, I think we're over.
Absolutely. Just a couple of things before we wrap up, guys. We're going to be opening up a poll right now because we do plan on, as a firm, to be hosting basically monthly seminars. Okay, so if you can go ahead and talk about some of the topics that you would prefer us to cover as we continue to do these seminars on a monthly basis. I'll do a quick plug for our next one, which will be on student loans. So if you have kids, cousins, family members, friends that you believe would see some value in learning more about how to manage their student loan debt, we'd be more than happy to have them on the call. It's going to be August 13th, and we're going to have 3 different times, but we'll be sending out correspondence to everybody about that. So again, thank you guys so much, and I see you guys participating. Look at that. Already 21, 25. You guys are a great crowd. So again, we really do appreciate everybody on the call. Be safe, and we look forward to seeing you next time.
Bye, everybody. Thanks so
Bye.
much.
Thank you all.
Thank you
Thank
so
you,
much.
guys.